If you are waiting for the world to feel safe before you start building serious wealth, you are going to miss the most important part of the move. That is the first truth. Big wealth is almost never built when everything feels obvious, calm, and publicly approved. It is usually built in periods that feel messy, unstable, half-resolved, and emotionally exhausting. Periods where the headlines still look dangerous, the macro still looks broken, and most people are still too confused to tell the difference between temporary fear and structural opportunity. That is where we are now. And if you do not understand that, you are going to keep asking the wrong question. You will keep asking whether the market feels safe enough. You should be asking whether the biggest engines of future value are still early enough, mispriced enough, and misunderstood enough to matter. That is the mother line. This is not mainly about calling the next headline. It is about deciding whether you will be an owner in the next system or merely a consumer living inside it. The source document opens in a place that makes many people uncomfortable. Stocks have rallied sharply. The Nasdaq has recovered. The S&P 500 has recovered. Bitcoin has recovered. Every dip seems to get bought. On the surface, it feels like euphoria has returned. But underneath that surface, the document is careful to say something more useful. This is not a clean everything. Is fixed rally. Oil is still high. The Middle East is not truly settled. Inflation pressure has not vanished. The Federal Reserve is still not giving the market the easy money comfort it wants. The rally is happening anyway. That matters. Because once a market starts rising in spite of unresolved problems, you are looking at something much more powerful than relief. You are looking at pre-positioning. That is the first mechanism I want you to understand. I call it the market ahead effect. Most people think markets move when problems disappear. That is not how serious money behaves. Serious money moves when the probability distribution begins changing enough that the upside from getting positioned early is more valuable than the emotional comfort of waiting for perfect visibility. That is why markets can climb while headlines still look ugly. Not because the risk is gone, but because capital has already begun choosing where it wants to live. If the next version of the world is bigger, more digital, more automated, more AI-driven, and more capital-intensive than the old one. That is what you are seeing now. A lot of people mistake this for irrationality. It is not purely irrational. It is selective anticipation. Now, I agree with one thing the source text says very clearly. This is not a full macro resolution. A ceasefire extension is not peace. High oil is still high oil. Inflation still matters. Jerome Powell or Kevin Warsh or whoever occupies the next chair at the Fed is not going to magically erase the structural tension between growth and prices. The point is not that the macro is fixed. The point is that the market has decided the future may still be worth owning even before the macro is fully fixed. That is a huge distinction. And if you miss that distinction, you end up doing what ordinary people always do at the worst possible time. You wait for comfort. Comfort is expensive. This is the second mechanism. I call it the comfort penalty. The average investor wants the same three things before acting: clear headlines, clean momentum, strong consensus. The problem is that when those three conditions finally arrive together, most of the cheapness is already gone. The market does not reward emotional peace. It usually charges you for it. The person who waits for everything to feel good again is often buying after the real asymmetry has already narrowed. That is why I have never admired the all-clear instinct. The all-clear usually comes after the opportunity has already become socially acceptable. And socially acceptable is often just another phrase for late. Now, let us move to the bigger argument inside the source document, because that is where things become truly interesting. The real issue is not just whether this rally continues. The real issue is what kind of world this rally is trying to front. That is where the AI discussion matters. You do not have to agree with every extreme version of the argument to understand its direction. When the people building the most powerful artificial intelligence systems in the world begin speaking openly about large-scale job disruption, universal basic income, universal basic wealth, and a future where the productivity of machines radically changes labor's role in the economy, you do not have to become hysterical, but you do have to become serious, because powerful people do not begin planning around those ideas for fun. They do it because they can already see what ordinary people still debate emotionally. This is the third mechanism. I call it elite pre-adjustment. The people closest to the machines usually see the implications first, not because they are morally better, because they are geographically closer to the future. When the source document cites Elon Musk, Sam Altman, and major government figures discussing some form of income support or wealth redistribution to deal with AI displacement, The shallow interpretation is political. The deeper interpretation is structural. They are telling you in plain sight that they believe machine productivity is going to outrun human adjustment at a speed the public does not yet emotionally understand. That matters a great deal. Because if that future arrives even halfway the way they imagine, then one thing becomes immediately obvious. Ownership will matter more than ever. If labor becomes less scarce while capital, software, networks, models, infrastructure, and the asset layer beneath them become more powerful, then the real dividing line in the next era may not be between hardworking and lazy people. It may be between owners and renters of the new system. That is why I think the source document is emotionally loud but strategically useful. Underneath the urgency, it is trying to push you toward the same realization I would put much more quietly. You do not need to predict every twist. You do need to own something that benefits if this future arrives. That is the whole game. Now, what should that ownership look like? The source text suggests a few broad categories. Large cap U.S. stocks that still sit at the center of AI optimism. Bitcoin as a monetary and speculative upside vehicle. High conviction crypto infrastructure plays. Some exposure to hard assets like gold. And selective tactical positions where narrative, liquidity, and asymmetric upside can line up before the crowd fully notices. I think the spirit of that is correct, even if most people need a calmer operating system around it, because the fourth mechanism is what I call layered asymmetry. Most people hear asymmetric opportunity and immediately think they need one giant bet. That is amateur thinking. Real asymmetric positioning usually comes from layers, a stable core that compounds a smaller layer of higher upside risk, a reserve of cash for volatility, and the temperament to keep buying when the news still looks ugly. That is how you survive long enough for asymmetry to matter. This is why I do not think the real lesson of the source document is buy these 5 things and get rich. That is too childish. The real lesson is that markets reward you when you can identify where attention, liquidity, technology, and structural demand are likely to meet before the wider public organizes itself around the story. That is what the aerodrome anecdote in the source is really trying to teach. It is not just a story about one trade. It is a story about narrative recognition before mass recognition. Seeing the connection between Coinbase, base, user migration, liquidity concentration, and a token likely to sit at the center of that flow before retail fully understood the architecture. That is how asymmetric opportunities are usually found. First comes the system shift, then the attention shift, then the liquidity shift, then the public story. If you arrive only at the public story, you are late. That is the pattern. Now let us talk about Bitcoin, because whether people like it or not, it has become one of the central expressions of this entire era. The source document treats Bitcoin as one of the cleanest base layer exposures for this cycle, and I understand why. It is liquid, it is globally legible, it has become institutionally harder to dismiss than before. It benefits from monetary distrust, liquidity cycles, and the public's constant search for a digitally native store of value or speculative upside vehicle. Depending on who is buying it and why, I still would not call it certainty, but I would call it a serious part of the modern opportunity set. This is the 5th mechanism. I call it monetary optionality. Bitcoin is not just a number go up asset to serious allocators. It is a claim on a different type of monetary future, a future where digital scarcity matters more, a future where people want some distance from the full discretion of central banks, a future where portability, narrative, and network belief can create real financial gravity that does not make it riskless. Quite the opposite, it remains volatile, political, and emotionally violent. But volatility and uselessness are not the same thing. A volatile asset can still be strategically important. That is a distinction ordinary people often miss. Then we move to what the source text is even more excited about, which is crypto infrastructure and protocol level asymmetry. Hyperliquid is the clearest example in the document. The excitement there is not merely because the token has gone up or because the community is loud. The deeper case is that it sits at the intersection of trading, liquidity, fees, non-crypto asset exposure, and increasingly broader financial rails. In other words, it is not just another coin in the source writer's imagination. It is being framed as a piece of future market plumbing. That is a much better reason to care. Whether Hyperliquid specifically succeeds exactly as expected is a separate issue, The more important logic is the kind of logic being applied. Instead of asking which token is the loudest, the source is asking which system sits where volume. Users, product expansion, and fee capture can all reinforce each other. That is the right kind of question, and it applies far beyond crypto. The sixth mechanism is what I call functional ownership. The best asymmetric opportunities are rarely the prettiest ones. They are often the ones sitting inside a function that becomes increasingly necessary as the larger ecosystem expands. A decentralized exchange that becomes a toll road, an infrastructure layer that becomes the default backend, a treasury vehicle that becomes the public market wrapper for a rising asset. A protocol whose user behavior turns revenue into buy pressure. These are all different expressions of the same principle. Do not just own excitement, own necessity inside excitement. That is where a lot of the edge lives. Now, the source document becomes more speculative when it starts talking about PER, BMNR, Pudgy Penguins, and some of the other names. Fine. That is where the writer's personal style leans more heavily into active speculation and narrative timing. I would frame it more carefully, but I do not want to lose the valuable part hiding inside it. The valuable part is that cycles always create secondary and tertiary expressions of the main trade. If Bitcoin becomes the core beneficiary, then treasury wrappers around Bitcoin become leverage expressions. If Ethereum matters again, then equity vehicles built around Ethereum exposure become derivatives of the derivative. If consumer crypto branding wakes up, then a meme. Adjacent but culturally sticky name may catch huge attention flows despite looking unserious to outsiders. That is how cycles work. The core asset moves, then the higher beta satellites wake up, then the risk appetite curve steepens, and then, if things get truly hot, people begin buying the story of the story. That is where fortunes can be made, and where many are later lost. This is the seventh mechanism. I call it the rotation ladder. A lot of people think bull cycles move like a flood. In reality, they often move like a ladder. The strongest, safest, most institutionally accepted assets move first. Then attention rotates outward, then leverage and narrative expand, then lower, quality but higher. Beta names begin catching the flows. If you understand where the market sits on that ladder, you can position more intelligently. If you do not, you either buy too much garbage too early or too much safety too late. Both are expensive. Now, I want to slow down and say something very important. The source document is emotionally effective because it says, this may be your last chance at generational wealth. I understand why that message hits people. It creates urgency. It makes the opportunity feel morally serious. It is not entirely wrong either. Great wealth. Building windows do not open indefinitely. There are periods where a new technological system, a new monetary system, or a new infrastructure layer gives people who are early disciplined and right a chance to compress decades of ordinary financial progress into a few concentrated years. That is real. But urgency without structure is how people destroy themselves. So here is the calmer and more useful version. This may be one of the last periods in which ordinary people can still buy meaningful ownership in the new machine before the next system becomes so mature, so institutionally captured, and so socially obvious that the biggest asymmetry is gone. That is a serious thought, but the correct response is not panic, it is disciplined aggression. That is the eighth mechanism. I call it disciplined aggression. This is where the source document is strongest when stripped of its noise. The best move is not sitting in cash waiting for the perfect 20% dip. The best move is not trying to time every war headline or every Powell speech. The best move is also not blindly shoving your life savings into the hottest ticker. Someone mentioned in a viral video, the best move is a repeatable system. A core position in the assets you believe the future must reward. Gradual buying when the thesis still holds. Cash reserves for volatility. Conviction built from real research. Not just vibes. A watch list of higher upside names that can be attacked more aggressively when the market confirms them. And above all, the emotional control not to become euphoric at the top or paralyzed at the bottom. That is how people actually capture these windows. Not by being perfect, by being present and prepared. This is why I agree with one of the document's simplest ideas. Dollar cost averaging is still one of the smartest things an ordinary person can do in uncertain conditions. Not because uncertainty does not matter, because uncertainty is exactly why most people fail. They keep waiting for certainty that only arrives after the most important part of the move has already happened. The market punishes that behavior relentlessly. And this is where I think the final lesson becomes clear. Generational wealth is not created only by intelligence. It is created by three things acting together: correct direction, enough size, enough time. If you have direction but no size, the opportunity does not change your life. If you have size but no time, you panic before the thesis matures. If you have time but no direction, you merely drift. The reason windows like this matter so much is that they create the possibility of putting all three together at once. That is very rare. So here is where I come down. The current environment is messy. The war situation is not fully resolved. Oil still matters, inflation still matters, the Fed still matters. Another correction is absolutely possible. None of that changes the deeper point, the high time. Frame future is still likely to reward ownership in the technologies, networks, assets, and monetary alternatives that benefit if AI, automation, and capital concentration continue reshaping the economy the way the people closest to them believe they will. That is the actual trade. Not one perfect headline, not one perfect entry, not one magical token. Ownership of the future before the future becomes too socially obvious to be bought cheaply. That is what this moment offers. And if you understand that, then the right question is not whether everything feels safe enough to begin. The right question is whether you are willing to build a system that keeps you steadily exposed to the next order of wealth creation while the crowd is still distracted by fear noise and the temporary ugliness of the present. That is how fortunes are actually built, not by waiting for the world to calm down, but by understanding what is still getting stronger while the world is noisy enough to hide it.